Hello everyone. I see I've already got 2 likes here, so things are going well. Crypto Knight, good to see you. Let me know if everything comes through okay. We're getting audio and the rest of it. Hello everyone. I see. Let me know if everything comes through okay. We're getting audio and the rest of it. Hello everyone. Excellent. Okay, let's kick things off. So thanks guys for tuning in. Welcome to the second episode of the Ready Set Crypto on-chain masterclass. So here we're looking at a pretty interesting study, which is modeling value with scarcity. So what we're going to do is delve into Bitcoin's monetary policy, understand why the scarcity that was constructed by Satoshi's original design with the 21 million hard cap and the deterministic supply rate, how we can actually look at that and start using mathematical models, and a fairly simple one at that, and observations of how prices actually performed through history to build up some kind of predictive model to look at what kind of price valuations we've seen in the past and what we can potentially map out into the future. So there's a huge amount of credit to Plan B, who goes by their Twitter handle at 100 trillion USD on Twitter, and Saifuddin Ammous, because I mean really he was the first one to really, I think, make Bitcoin's monetary policy and the scarcity argument a part of the Bitcoin canon. So that's some great resources there, and definitely worth keeping in touch with them online. So a bit of a flow about what we're going to go through today. We'll look at what scarcity actually is, how you would define that, and then what stock to flow ratio actually means and why it's actually a good metric for measuring scarcity. We're going to look at Bitcoin and its scarcity and the monetary policy and how that design actually functions and works. We're going to go through and look at how Bitcoin compares to gold, because we keep saying Bitcoin is the digital gold, and it's worthwhile understanding why gold has value. And this is where Saifuddin Ammous's work in the Bitcoin standard is invaluable to understand what gives monetary premiums over history. And then looking at how we can actually model price using that scarcity and that stock to flow to build up some kind of model that we can arguably predict into the future to some extent. So a lot of on-chain and technical analysis studies is looking in the rearview mirror. You're looking at what's happened before and patterns. This is actually a mathematical model that can actually predict into the future, and it gives you something that you can forward predict. So some interesting work going on there. So what exactly is scarcity? Scarcity really is a measure of how hard an item or an object is to obtain, and whether that's by creating it from scratch or finding it, and finding it could be trading it. What do you have to do to actually obtain this particular item or artifact? And really, uniqueness is the extreme end of the scarcity spectrum. So things like rare artwork have that one-of-a-kind, irreplaceable nature to them. And there's an origin story that normally goes with those things, that they just cannot be replicated in their original form. You can have counterfeits, but if you ever to have the two side by side and you knew which one was legitimate, the one of a kind piece will always have that higher value because it cannot be replaced. And that gives it that extreme end of scarcity. You then have somewhere in the middle of that, so you've got things like gold, which it's historically held value because it's durable, it doesn't break down over time. You can smelt gold down and you can mix bars. There's no one piece of gold is any different to any other based on purity, and it's got a relatively low abundance. So it's hard to come by gold, but not as hard to come by as a Van Gogh or the Mona Lisa or otherwise. So it is still scarcer than a lot of assets, but it's not as scarce as a unique asset. So it is a bit of a spectrum. So Nick Szabo had a really, really great summation of what scarcity really is, and it's a concept called unforgeable costliness. And by definition, It's what needs to go into that original production of a particular item, whether it's by finding it, whether it's by, in the case of gold, by mining it, or even Bitcoin mining it. And what is that original cost? It is unlikely it's something that is expensive and difficult to manufacture or produce. It is unlikely that item will continue to be traded at a loss through its existence. Otherwise, people will just stop producing it. So there's an initial cost, and on top of that, an improbability of their history. The reason that a piece of art has value through history is because you can never recreate the human being who actually went through the experiences and put that into a piece of artwork. So there's an improbability of how likely that thing is to exist. Gold, because you've got a limited abundance, there's an improbability of actually striking gold, right? So that's what he terms as the unforgeable costliness, and it's something that you can't spoof. You can't recreate that difficulty. You can't obtain the item without undertaking that initial work or putting in that initial cost and effort to produce the item. So that's really what he touches on there. So it basically describes the value that's inbuilt to an asset based on how hard it is to acquire. So it is an interesting concept to take forward as you start looking at why an object is actually scarce. So if we look at different assets or different asset classes, and we'll go through a bit of an example with the spectrum, but on the extreme end, you've got a unique asset like a Banksy, and in particular, Banksy's a really good example because you have that anonymous founder. There's the personality and the mythology of the actual artists themselves. What's their story? What's their back history? Where they come from? And then you've also got the social and the cultural capital, the historic capital that sits behind that artwork. If you're looking at a historic piece, it captures a piece of history that cannot be replicated. It was produced at a political time when it had something that was it was unique, right? It captures a certain mood, and it's a piece of history. So it does take on that extreme end of the uniqueness where no matter how hard you try, nobody will ever be able to create Girl with Balloon running through a shredder again, right? It is a completely unique event. It captured a piece of history, and you can never recreate that. So it is that extreme end of scarcity, and that is irreplaceable. If we look at something like gold, there's a huge amount of time and cost that goes into producing gold. I mean, gold mines take 10 plus years to spin up, enormous capital investments. Plus you've actually got to go through the whole exploration process, and there's costs and time to get mining licenses and all that kind of thing. So the unforgeable costliness is quite substantial. And on top of that, there's not a great deal of it in the earth. So it has a naturally low abundance. It is fungible. So it's not quite like diamonds where you've got, some diamonds are much, much harder to come by because of their quality and their condition. But it's more scarce than, well, let's say fiat money, which has a virtually no cost to produce and an inflationary supply. Effectively, they are limitless. How hard it is to come by paper money. I mean, everything you do, whether you're working a job, whether you're selling something on eBay, whether you're buying something from the shop, there's a transfer of dollars and pounds and yen all the time. So in general, it's actually fairly easy to come by paper money. So, because it is that fully fungible and really supply is unlimited, it actually falls into the category of what you'd say is actually not scarce. And a lot of this builds up the argument as to why we have this different spectrum, and whereabouts on this spectrum does something like Bitcoin actually exist, and why does that scarcity give it that value? But you can kind of see, if you tear down these things, there is a value associated with the Banksy. There's a value associated with gold, and there's value associated with dollars, and in general, they're not one-to-one. So if we introduce a concept called the stock-to-flow ratio, so this is a great way to actually, or a great metric to surmise what scarcity really is. And if we look at something like a fungible asset like gold, precious metals, we can look at how much we currently have above the surface, which is kind of a pre-existing stock. So for some assets, we use that stock for things like copper. We're always using it in copper wires and electronics. So the stock is always being depleted. But then we also have the flow, which is what is the actual annual production, or the inflation rate, more or less, of that asset. So you've got a pre-existing stockpile and you've got a consistent flow or production that's coming in. So stock to flow ratio is literally the ratio of those two. And it's basically the inverse of the inflation rate. If you do 1 over inflation rate, that gives you stock to flow. And it's basically a measure of how many years, if you took an annual inflation rate and you invert it, that's telling you how many years it's going to take to reproduce the existing stocks. So if we look at this as in terms of the properties of a high stock to flow ratio, effectively, if your stock to flow normally greater than 1, but it varies depending on what asset you're looking at, but when you have a high stock to flow ratio, it means that you have a lot of pre-existing stock and a very low inflation rate. So in most cases, the stock is held somewhere. Stock of most assets and commodities are held by somebody. And if you then got a small relative inflow coming in, that's normally the amount that's available as for the demand side, right? You either have to buy the stock off someone else or you buy it as part of the production. So if a lot of it is already held in stocks, in a stockpile somewhere, it's generally a smaller supply to get hold of, and therefore you've got the same demand with a lower flow. It's hard to come by. And things like gold and silver are the monetary metals that have shown this property to have a high stock to flow. Even things like fresh water, there's a lot of water out there, but not a great deal of it is fresh water and potable and drinkable. So I think fresh water, if you were to do the mathematics, would probably be one of the scarcest assets on earth. And amazingly, Bitcoin managed. Well, it didn't used to be, but in its first couple of weeks, but as of now, it's pushing up there in terms of a high stock to flow ratio. And when you look at things like a low stock to flow ratio, you've actually got the other side. So there's two things that can make a low stock to flow. One is that you're constantly depleting your stock. So if you're always using your stock, then the flow that's coming in is going to have more of an impact to dilute what's left. Or you have a very, very high flow relative to your stock. So very, very high, very easy to spin up a copper mine by comparison to a gold mine, or, it's very easy to turn on the printing press and start printing paper money if things go all awry. And that's why you get a lot more volatility. There's a lot more price volatility in low stock to flow materials, and things like copper, wheat, crude oil, which are always being produced and consumed. So there's a constant battle between building stocks and production, and then paper money, which has the same thing, right? When things get too awry and you get periods of hyperinflation, it loses all its value because effectively your stock to flow ratio drops substantially. This is mapping out a couple of different assets, commodity assets, and this is what I was talking about before, where those assets that are used on a frequent basis, copper and oil and things like that, tend to all sit with a stock to flow less than 1. Once you move into the realm of precious metals, you start seeing stock to flow ratios greater than 1. And those materials, particularly monetary metals, with a very high stock to flow ratio, have historically attracted a monetary premium. So you can see here in the solid bars is actual numbers or realized stock to flow ratios. And you can see in there in the orange that Bitcoin in 2012 had a stock to flow of 7.4, which was less than diamond, less than silver, less than gold. 2016 after the halving, and these are all numbers immediately after the halving event, you can see that because the inflation rate or the flow got cut in half, your stock to flow actually more than doubled. So between 2012 and 2016, there's still inflation, so your stock is always increasing, which is why it's not a direct 7.4 multiplied by 2. So your stock to flow ratio for Bitcoin is actually in a constant state of change. But every halving, it doubles. So you can see that in the 2020 halving, Bitcoin is now starting to approach gold. And there's two markers for gold there, one being gold total, which is the total supply of gold, presuming that it all doesn't degrade. And that includes things like jewelry, monetary, things that are in bank vaults and everything, industrial use cases, all the rest of it. And then there's the gold for investment, which is purely that's held by either central banks, national banks, or by private investors in ETFs and things like that. So that's got a much smaller stock for investment only, and therefore, a much larger stock. So your stock to flow ratio is much larger for that investment side of things. So they're kind of the boundaries, but you can see in 2024 that Bitcoin actually takes over as the scarcest asset that we have. And from there, it pretty much goes exponential, and we'll have a look at that in more detail. So if we look at gold, which has historically been the highest stock to flow ratio the commodity that we've ever had, and has historically been sound money. It has a natural resistance to degradation. So most of the gold, if not all the gold that's ever been mined, remains in circulation in some form, whether it's jewelry, investment, national vaults. It has a very, very high pre-existing stock, and it is substantially higher than the annual production, which is something like 1.75%. And if you look at the gold that's only going in towards available for investment, it goes down to 1.2%. So almost 50% of gold supply goes towards jewelry. So if you're looking at how much is actually available to buy as an investment, and you do 1 over 1.2%, you get that 101 stock to flow ratio. So the actual amount that you could buy as a investment is substantially less in terms of the annual flow. So that's really what gives it that difference there. So I did some mathematics looking at the properties of gold, and the annual average inflation rate from 2010 to 2018 was about 1.62%. Gives you that stock to flow of 61.6, and it is the highest of any commodity that we have in the market today. So if you look at the gold that's only done for investments, it goes up to that 108. What this doesn't do is take into account the concept of peak gold, which is expected to occur in the next decade. And peak gold is effectively where we're going to hit the maximum possible production level of gold. And from that point, both due to gold's naturally low abundance, but also we hit that point where the inflation of gold is likely to drop. Now, we don't know what this is going to look like into the future. So gold stock to flow ratio will actually also start to increase. But if you run some kind of sensitivity analysis on this, you'll find that peak gold really has to be a significant event, and there has to be a significant reduction year on year for the stock to flow of gold to chase Bitcoin. So it's going to be interesting, and we can't ignore that gold's going to continually become scarcer and scarcer as the flow reduces and the stock continues to go up. But it's probably not going to go on the exponential run that the Bitcoin will. But who knows what the future holds. So now we delve into Bitcoin and Bitcoin's monetary policy. So Bitcoin was the first example of a digitally scarce asset. What Satoshi really solved here was previously all digital assets could just be copied, and really that's what things like the Pirate Bay and torrents were. Things became, infinitely inflatable because you could just copy digital assets anywhere on the internet. What Bitcoin really did was allow individual coins to actually be scarce, and you cannot copy it. Once it gets transferred, that ownership of that asset is immutably transferred. So the hard-coded monetary policy is really the key invention here. And it's that 21 coin maximum supply, a deterministic supply curve, which is based on block time, which is, it targets 10 minutes, but it's not exactly 10 minutes. But all Bitcoin sees is block time. It doesn't see our typical date time. It's got coin issuance in reward for proof of work, and that requirement for electricity and hardware to actually undertake that proof of work is what provides the security, but it's part of that unforgeable costliness, right? You can't generate Bitcoins without putting in that work. You have to actually generate that security for the network in order to be rewarded with those coins. So each coin actually has, a backing of that unforgeable costliness behind it. And then the coin issuance halves every 21,000 blocks, which roughly works out to about 4 years, which effectively doubles your stock to flow ratio or halves your inflation rate, whichever side you want to look at. So the unforgeable costliness of Bitcoin comes from its origin story. that anonymous founder that nobody knows who it is and remains to this day. It's that improbability and uniqueness which can never be replicated, very much the same as a Banksy or a Van Gogh. And the proof of work provides the network security and immutability that converts electricity, which is your OPEX, and hardware investment of the ASICs, which is actually why ASICs are extremely important, which is the CapEx, to generate those newly issued coins. So the unforgeable costliness here, because all we've seen is hash rate increasing, the unforgeable costliness continues to increase while inflation actually slows. So the cost to produce Bitcoins increases over time, but the supply decreases. And no matter how much hash power you throw at it, the genius of difficulty adjustment means no matter how much hashing you put at it, you will only ever produce less Bitcoins. So your unforgeable costliness continues to go up. And it's this ingenious balance between scarcity on the demand side, because the monetary policy gives hodlers and people who want to make that investment, it gives them a reason to be the demand, and the production side, who are continually putting in that unforgeable costliness, and they see the demand increasing but the scarcity going up. So therefore, the asset goes up in price, and there's this ingenious balance between demand and supply. So if we were to plot out what Bitcoin's monetary policy looks like, we've got the blue line, which basically is the actual coin supply mapped to the left. And then we've got the inflation rate with the halving events and the coins issued for that particular cycle. And what you can see is basically following a stepped pattern where every 4 years, roughly, you get that halving in the inflation rate. And in between each of those halving events, there's a slight decline in the inflation rate. And the reason for that is because every block, every 10 minutes, the block reward is released, which increases the total stock by just a little bit. You have the exact same coins per block, so your inflation rate or your inflation magnitude is the same, but the stock is higher. So your inflation rate is actually dropping every single 10 minutes and then halving every 4 years. If we then invert that, you end up with your stock to flow is actually increasing a little bit every 10 minutes until it doubles every 4 years. So Bitcoin's issuance effectively follows a fixed disinflationary release schedule that eventually ends up near zero sometime after the year 2140, which if any of us see, it'll be quite remarkable. Every block that's mined effectively increases the total supply by a small quantity. That's your stock. Every 4 years, the halving event comes along, halves the block reward, which then halves the inflation rate, halves your flow. So your stock to flow ratio of Bitcoin, which is historically shown to be providing a monetary premium once it gets above 1, continues to rise to infinity, following a regular doubling pattern at each halving. Bitcoin's stock to flow ratio will overtake gold on the May 2024 halving. That will in fact make Bitcoin the scarcest financial asset on earth. So this is basically the same plot, but looking at, instead of inflation rate, we've actually flipped it over to look at stock to flow ratio. So where we said before that gold had that stock to flow between 60 and 100, that's those two gold lines. So even if you look at the total supply of gold and you look at the gold available for investment only, you basically end up with that band between those two gold lines. So Bitcoin's going to continue to increase its stock to flow ratio until that May 2024 halving, at which point it's going to slice through both of those levels. And assuming that peak gold doesn't kick in and with a fairly substantial drop in production between now and then, it is more than likely that Bitcoin will become the scarcest asset on earth, financial asset on earth, at the time of that 2024 halving. So it's going to be an interesting lead up to there, but you can see that stair-stepping pattern, and surprise, surprise, looks a little bit like Bitcoin's price rise to date. So now we move on to some interesting work that Plan B developed. And this is how we can start looking at this stock to flow ratio, which we've already seen resembles a little bit like Bitcoin's meteoric price rise to date. And we can look at whether we can actually model the value of the Bitcoin network by using scarcity as our fundamental metric, and see whether that scarcity actually does have an effect on asset valuation. So it's hard to quantify the value of a founding story. How much how much is Satoshi Nakamoto's story really worth? How much is it worth being a Banksy versus some other artist? It is a subjective thing. However, when we look at commodity assets like gold and silver, we've seen that historic monetary premium and that correlation between a high stock to flow ratio and total market asset value. So if we can look at stock to flow ratio as a metric for scarcity, can we compare that market valuation of these gold, silver, and Bitcoin to identify whether there's some kind of relationship between this scarcity metric and network valuation? So we'll take a couple of data points, particularly from the monetary units. And you can see here gold, silver, diamonds, palladium, platinum, and Bitcoin as at one particular point in time. So the chart on the right is one of Plan B's, and he's looked at those different monetary assets on a log scale. So on the x-axis, you've got stock to flow scarcity. On the right axis, you've got total market value. So it's actually the market value of these monetary assets. And it's worth noting that things like palladium and platinum have industrial use cases. So their stock is constantly, at odds with the flow that's coming in. Assets like gold have substantially less use cases in terms of outside of jewelry. Once you go into the investment space, that's kind of the dominant use case. You've got a large percentage there, and silver, which used to have a much higher monetary premium, actually lost a lot of its monetary premium following the move away from, basically, to paper money, because silver used to be the divisible version of gold. And once they moved to paper money that was backed by gold, the divisibility of gold became effectively superseded silver. So over time, silver has actually lost its monetary premium. And then we have Bitcoin. So basically what this study does, it looks at a bunch of points along Bitcoin's stock to flow supply curve, and it basically plots what the network value was worth at that time versus what the actual stock to flow ratio was. And what's fascinating here is when you've got a chart that does this, where it's basically a linear trend line in log space, it's what's referred to as a power law. And these only show up in very, very few scenarios, but when they do show up in the laws of nature, they have actually proven to be extremely reliable. So it's worth actually doing a bit of a Google and seeing what kind of natural phenomena exists in that power law, because it's quite an interesting study. And what's interesting to note here is that the heat map, the hotter the color of the Bitcoin points, the further away from the halving that you are, and the closer to blue you are, or the cold colors, is on the event, on the date of the halving. And what fascinates me is from the two halvings that we've had to date, it pretty much, the price and the network value closes in on this line. And this trend line that you can see the equation for has an R squared value of 0.95. And what that basically means is that there is a 95% chance that the network value is related to stock to flow in this linear fashion. It's basically saying that there's about a 5% deviation of all these data points from that particular line. And what fascinates me is how close gold falls to that exact line. Now, gold's been around for a long, long time. It's been a monetary metal throughout history. And the fact that this line actually matches up with, you could basically predict gold's market cap if you just looked at the Bitcoin price chart. And to me, that's a fairly fascinating observation with a 5% deviation. So this is basically my plotting up and trying to have a look at these and looking at the different data points. And I've plotted there, I think the one to notice is gold total and gold investment. And more or less, you're getting a very similar response here. When you look at these two different stocks versus flows, it's falling in that same category. What's interesting to note here is this is looking at silver with a slightly different data set prior to silver losing that monetary premium, and it's amazing how close it actually falls to that stock to flow line. So it's a fairly robust study, and again with an R squared of 0.95, it's pretty close to the mark. So this high correlation factor of 95%, it does indicate that stock to flow and market value are very strongly related, and the chance that it's pure coincidence is very low. We can now take the known Bitcoin issuance schedule, combined with this prediction model, to estimate the potential Bitcoin network value in the future, because we can actually calculate the stock to flow of Bitcoin, assuming 10-minute block times. We can actually assign a date to when the halvings will be, and we can assign a date to what the stock to flow will be with reasonable accuracy. And what we can see with these heat maps is we do in fact expect that the estimates are going to be fairly accurate on the date of the halving event. So you can kind of use that a bit of an anchoring point. And what we've seen historically is that price will slightly front run. It will hit the predicted level and then basically accelerate parabolic, kicking off a fairly substantial euphoria run following the halving event. So it's worth noting that these are just estimates, and it's obviously a simplified perspective of reality. But as more data points come about, and the longer that Bitcoin keeps ticking over those 10-minute blocks, the more data we actually end up with. And especially after this third halving event, if we do in fact see a validation of the model with 3 significant data points, it will add a lot of strength to this particular model. What is really interesting is that if you took the first 4 years of Bitcoin's history, you could have actually predicted the price floor of all 3 of the bear markets to date. And all of this is happening before this study has come by. So this study is looking at things in the rearview mirror and then projecting forward. But this is what happened irrespective of people looking at this. And how much of this goes by design is it goes back to how much did Satoshi actually look forward and understand these concepts. And I would argue there's a fair chance that he probably understood a good portion of it. So this is using Plan B's data and mapping out in the yellow line we've got the realized price, which is effectively the cost basis for the whole market, or the price that all the coins moved, which we covered in episode 1. In the orange you've got the market cap, or the spot price, more or less. And then in the green is individual data points along Bitcoin's history where we have a stock to flow number and we have a Bitcoin price. And you can see here how well those crosses actually mapped out the price floor of every single bear market to date. And to me, that's quite fascinating that we're able to actually predict forward predict where the price floor is going to be following a halving event. And more importantly, when price actually deviates substantially away from this predicted model, particularly to the upside, it suggests that we may in fact be moving into that euphoric phase and potentially a market top. So what's quite interesting is where we sit today. Granted, this is a couple of days older, but our realized price a couple of days ago was sitting down around 4,700. The scarcity model price is somewhere around 6,900, and actual price is sitting up around 7,700. So what's going to be really interesting is to see, as we come up to the halving, where we've actually had that very strong correlation, will price still be sitting somewhere around a $7,000 to $8,000 range, where the stock to flow model predicts it will be. That'll be some interesting data points to look at. So you can see here, again, mapping out what this might look like into the future. And again, this is all theoretical modeling, but if you were to map this out long term, you can start to see that individual Bitcoin prices start to get a little bit crazy. And how much credence you put to this is entirely in your own court. But it's going to be interesting the more data points we actually end up with here, as to what a potential price. I mean, are we going to continue to see this thing just ripping to the upside simply because the stock to flow ratio is going to continue to infinity? I would suggest that we will see some deviation as time goes on, and I would probably use this model sparingly, but it certainly gives you a context. And the fact that we've seen this behavior even without all of this information, without all the on-chain analytics, and without more and more people looking at this particular market, as we see increased adoption, we see more people enter the fray, we see demand go up, but we see supply come down. really this is what's given monetary premiums through history. So it's going to be very interesting to see just how well this model performs, and really we can continue to update it the more data points we get in. Basically, every 10 minutes you get a new data point, but there's a degree of machine learning I'm sure you could run to map out exactly what this would look like to the nth degree. And look, if you project this thing into the future, who knows if this thing's going to keep stair-stepping into infinity? But we'll have to wait and see. So if we want to kind of wrap this up, throughout history, what we've seen is that scarce commodities have attracted a monetary premium. It's shown to be a valuable metric for analyzing scarcity, and the stock-to-flow ratio is probably the best metric to actually understanding how scarcity works, at least for commodity assets, because it is so difficult to price that unique, unforgeable costliness of the anonymous founder. So by comparing the stock to flow between scarce assets, we can actually start to establish that a relationship does exist, with 95% correlation here between scarcity and market value. So Bitcoin's hard-coded monetary policy is what perpetually increases the stock to flow ratio in time. And the 2024 halving event is actually going to make Bitcoin the scarcest financial asset on earth, surpassing gold. And I do believe that that's going to be a significant point in Bitcoin's history, particularly where institutions who understand the gold market and the gold bugs, if this does occur and we continue to see price rise, it will start turning heads. And I think it's going to be a fairly substantial moment in Bitcoin's history. So using the modeling that Plan B put forward, we can in fact use this as an estimate for a pricing model of what I would call a fair market value or a monetary premium. I think is potentially a better term. What we would call a monetary premium based on that power law relationship that we see between stock to flow and market value. And what I think is extremely valuable is that the model is actually shown to predict that realized price floor of bear markets. And I think what this does is it provides us a very good tool to understand what that monetary premium is worth, and it can help us to actually set realistic targets rather than just assuming that things going to infinity on day one. We can use this to set realistic targets as to when prices go on a bit too far too fast, or where we can actually start looking at accumulating value as these cycles continue. So some of the challenges and limitations, just to close out. Basically, we're modeling a relationship between market value and scarcity. It is an observational approach, and we're using backtesting data, and we're looking at how this relationship will project into the future. And the speculative nature of Bitcoin as an investment will lead to many different fluctuations. The pricing will change, and price will do whatever it wants to do. And I do think that this is going to guide a much more macro trend, a much larger scale change in price, which is why I think it's better as a long-term deviation and price floor type tool. But really, at its core, this is a reflection. It's an observation of how Bitcoin's monetary policy has actually created that monetary premium as a store of value. And it still amazes me how closely it aligns to the traditional gold and silver markets through history. So as Bitcoin's technology develops, there's going to be more use cases. We're going to get changes in global sentiment. The validity of this model will get tested, but every 10 minutes we get new data points and new input data, which we can adjust. And we can look at how it actually changes over time. And in particular, at those halving events, that's really where you get the validity of this model and seeing how it can map out. But it's an interesting study. It's fairly easy to calculate the stock to flow of Bitcoin through time. You can then apply a fairly simple equation, be it in Excel or Python, however you want to do it. And it can actually give you some fairly interesting data that you can use to start building up what your long-term vision is for a fair market value or a monetary premium for Bitcoin. So there's a few resources, and I'll circulate this PDF so you can follow up and see some of these models. But I would certainly recommend, if you are on Twitter, to be following Plan B. He does a great job at releasing these charts on a regular basis, and he's constantly looking at different assets. Sometimes you look at an altcoin, and what he's found is that none of them have that unforgeable costliness that that Bitcoin does, particularly when it comes to the founding story. So it's he releases a lot of interesting work. There's a podcast with him on Stefan Livera's podcast, so that's worth chasing up. So that closes out Module 2. If anyone has any questions or comments or thoughts, feel free to stick them in the chat room. Otherwise, it's been a good session, and I hope you got a lot out of it. So Crypto Knight, you've asked, at the next halving, the price prediction is about 7,300. If in reality it was around 25,000, would that change the prediction of price for the future halving events? Basically what you would see, let me go back to Plan B's chart. No, hang on, let me go back here. So if you get a different price variation, hang on, let me see if I can pull up my pen tool. So you're saying that if price ends up somewhere floating around here, right? What you would do is, because we're basically fitting a curve, so where we had the Plan B's chart, something like this, Bitcoin's price is effectively fluctuating around like this, right? If you did get a 25,000 point, what you're basically doing is you're plotting something up here, right? Now, what you would need, what these doing a linear regression analysis like this actually does, it's basically picking what the line of best fit is. So if you were to get a 25, right, and there'll be a couple of points that lead up to it, your R squared value, or the confidence of this straight line, would reduce somewhat. So you get a reduction in confidence. There would also be probably, at a microscopic scale, some kind of slight deviation to that line. And basically, the more data points, we could end up with very, very wild fluctuations, right, as time goes on. And what that will do is, you could end up actually having some confidence intervals, right? And you've got some kind of range. And this is where we don't really know what it's all going to look like in the long term, but it will evolve with time. And what it will do, it'll help you change your, I think, the confidence, right? So that 95, I would expect that R squared of 95 will continue to change. And I think we will probably lose some degree of confidence because new things like technology will come in. There's going to be regulatory changes. There's large macro events that will probably change how price reacts from a pure sentiment basis. So I think it will become more volatile in that respect, or who knows? It could in fact become less volatile. So what you would need is a deviation away from that line for a substantial period of time. In order to start really shifting the line. So I kind of look at this prediction model as a center of gravity. It's kind of it's the price that Bitcoin wants to be worth, which is, to me, the reason that I think it's come back to the realized price, and why it actually matches extremely well with the realized price, because it's the center of gravity for the network. It's the price that Bitcoin wants to be. It's the fair market monetary premium. And market cap is that volatile cousin that keeps moving around and wants to deviate all the time, but is continually hauled back towards that center of gravity, arguably by the laws of nature. So, any other questions, thoughts? Otherwise, we might close this out. The next module that I'll release will be on looking at the NVT and the RVT ratio. So that's going to be looking at how transaction volume and transaction flows compared to the network valuation actually provide you with some kind of guide as to whether the network is being overutilized or underutilized relative to the speculative value. So should be a good session, and that one should be ready in a couple of weeks. So thanks for your time, guys. Thanks for tuning in, and I'll make sure this gets uploaded in due course. So thank you very much. All the best. Cheers.